Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, hey everybody.
Hey Lauren, I thought we would do a series about index funds and index investing.
Okay.
But before I did that, in today's news, as we were planning this episode, I noticed that one of the academic heroes, Eugene Fama, won a Nobel Prize.
Yay.
Going way back to his research back to 1970, talking about the efficient market and
Right.
And that all knowable information is in the stock market price.
Right, yeah, exactly.
And then there was another gentleman named Lars Hansen, also from the University of Chicago, that also won a Nobel Prize.
Yes, and we will not even attempt to explain what he won it for.
No, he basically supported Fama's hypothesis. But the interesting thing was there was another winner, which was Yale's Robert Shiller, who is
Right.
well known for his predictions of the tech bubble crash in advance and the housing bubble. And now he's really famous for his Shiller, or I think it's called the Shiller Index for real estate markets.
Right, yes.
So if on the surface it appears that he won for his ability to predict the future,
Oh,
while the other Fama and Hansen won because they believe that you can't predict the future, and all knowable information from all the human beings on the planet dictate the true stock price at the moment in time.
right.
So what's your take on that?
If only I could even attempt to explain clearly what Hansen's contribution is. He kind of ties the two together. Shiller and Fama won primarily for their empirical research on how asset prices work and how markets work. And what Hansen came up with, this is probably not even right because it's so simplified, but basically he came up with a mathematical model or a mathematical method of estimating things even if your model isn't completely true, which is very interesting. But basically, what Shiller's research was about was not so much about predicting the future. It was simply about the effects that the price of things relative to something else has on its future expected returns.
Right.
And actually, even though that seems like the opposite of what Fama came up with in some ways, in another way though, it's always about the price.
Right.
I mean, every single thing that we do with investments that's any more complicated than just saying invest in the total stock market is based on price compared to something.
Right.
Price compared to the size of the company. That's why we invest in small stocks. Price compared to the book value or earnings of the company. That's why we invest in value stocks. So actually their research is more similar than people might think. And when Fama's research into value and small stocks first came out, people thought that it was a challenge to the efficient markets hypothesis.
Right.
We later discovered that that isn't true. Maybe some of Shiller's research might still be considered. But for me, I mean, I still use Shiller's research not because I'm trying to time the market to predict anything, but just because when the price of stocks relative to its earnings is high, the expected returns have to be lower. I mean, that's just how the world has to be. This is not, like a short-term prediction of any sort. This is just kind of the way things have to go.
And I think when they hear this term efficient markets, that makes it sound like that there can't be short-term fluctuations or spiking prices, up or down. We just went through the pain in 2008, and there was, of course, the tech stock bubble piercing.
Right.
But I think to finish off this episode, the article does a real nice job of what you're doing is tying them together, and all three of them agree that you really shouldn't be picking stock market advisors trying to pick advance what's going to happen. And they feel like that efficient markets can have short-term fluctuations, and it can be very intense, in fact. But over the long run, the markets do become efficient.
Right.
Okay, so that'll lead us into our next episode. So make sure to watch next week when we do the index stocks versus our structured index stocks. Thank you very much for watching this episode of Erickson TV. Bye now.
See you next time.